In this video, we're going to talk about Meta Materials, trading under the ticker symbol MMAT. The financial market is very volatile at the moment, and we gotta be careful about which stocks to pick, as well as the exposure and timing of our trades. This video is going to cover the recent price actions and the technical aspects of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events. If that's the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock increased to $1.70 before closing the trading day at $1.56. We should pay attention to the $1.47 nearby because it was tested 2 times as a support, making it a solid support for the time being. Over the past 30 days, the trend of the stock has been ranging between $1.44 and $2.20, meaning that Metamaterial is a stock that is now finding a support region after a very sharp decline as of late. From the perspective of a longer time frame, 6 months and above, the trend of the stock has been bearish since the title lost more than 60% of its value and was probably the result of a sector-wide decline. When we look at the price trend overall, it's been slowing down and finding some support for a prolonged period of time, which is a fairly positive sign for those who want to start buying the stock. The trading volume of Meta Materials has recently been 9.1 million shares, compared to the average volume of 6.3 million shares. Over the previous 52-week period, its price fluctuated between $1.38 and $21.76. The market cap of Meta Materials is currently at $453 million versus the enterprise value of $530 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every single time it publishes its financial statements, making it a less reactive estimation than the market cap, and often more lenient as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company is able to generate more profit or to have more growth than another company, partially because it may have a better management team, a stronger brand recognition, a bigger online following, and so on. It is what makes a company unique and worthy of our investment compared to its alternatives. It's not a tangible asset that companies may use, but it's often the reason why companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and it's also less reactive as well. If the company goes to liquidation, we would be left potentially with less assets to distribute to shareholders and debt holders than the number we currently see on the balance sheet. When we compare the current price to its historical price fluctuations, the stock is 12% higher than the 1-month low, 15% higher than the 3-month low, and 15% higher than the 52-week low. On the options market, which often gives a hint about the market sentiment, the implied volatility is 165%, versus the historical volatility of 130%. The put-call volume ratio is currently at 2%. It's normal for most stocks to tend to have a higher put option volume than what they truly deserve, as institutional investors systematically hedge their exposure by buying put options. The most recent volume of options traded is 6.2 thousand contracts, versus the 30-day average of 5.8 thousand contracts. Regarding the open interest, the most recent volume of open interest is 109,000 contracts versus the 30-day average of 90,000 contracts. In terms of its shareholder structure, institutional shareholders own about 27% of its outstanding shares. The biggest shareholders include State Street, Vanguard, and BlackRock. It's relevant to understand the shareholder composition of a company because it helps to determine whether you should be holding the stock long-term or to view it as a trade opportunity. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There are some exceptions to this because many great companies are also mostly owned by retail investors, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this is a sign that something more organized is going on. The current short interest is 15% of the total float, and 48% of it come out of the dark pools. Overall, my opinion on Meta Material is bullish because the stock is now at a sufficiently low level that if we go in now, there's a real chance that the rebound is going to benefit us massively. The exposure I would recommend is 1 to 3% of your portfolio. For the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are close to where the stock is at the moment. I would recommend to separate the allocation to batches of 20% at a time so that you can have enough room to purchase later. Your investment should also take into consideration the market conditions at the time and the surrounding sentiment that determine what kind of asset should be picked, for how much and for how long, and when you should be selling it. First of all, the financial market doesn't reflect the real economy. That much is a fact. If the stock market is doing great, it doesn't mean that the underlying company is necessarily hiring more people, increasing the wages, and rising the living standards of its employees. Sometimes it's even the exact opposite, because the stock market is a big pool where money comes in and out, goes to different places in order to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is been used for non-productive purposes like mergers and acquisitions, paying dividends to shareholders, buying back equity, and so on, the less there is for the productive parts. Another way to put it is that ever since 2008, the Dow Jones Index has increased its value significantly. But people don't necessarily see this growth in the main streets. This is why we should be careful with the assumptions of what rising prices mean for a company. Sometimes it doesn't mean anything, other than the fact that the asset is getting more expensive and that their yields is going down. Additionally, some new phenomena are now palpable, and they are the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullbacks. Bubbles have always been created over and over during the past few centuries, ever since there are financial markets. But nowadays, it's quite interesting to see that the speed at which they are created, attract people or capital, and then go bust is getting faster and faster. So almost immediately after the major collapse of the market prices back in early 2020, the same market decided to create a massive bubble of the electric vehicle sector or anything that is related to it. So almost immediately after the major collapse of the financial market back in 2020, the market then decided to, one, recover any sort of price that fell during the first 3 months of the year, and then attract a massive amount of capital into the EV sector or anything that's related to it. Stock prices across the board, but in the growth stocks in particular, went up to the sky for a moment. And even if it didn't last long, this episode definitely allowed market participants, or many of them, to park in their money in a sector and left with either a lot of profits or at least avoiding incurring large losses because they left their money in blue chips or the sectors that are heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, because in the scenarios of a short squeeze, companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then trigger even bigger increase in stock price. But I'm not saying that this is always rational, and I'm not even saying that companies will always have a very convincing narrative or good fundamentals. Sometimes there's none of that. A good example is with GameStop. If you play video games, ask yourself if you would really always buy your games at GameStop, knowing that you would be buying those games online as well, or knowing that at least you have the capacity, the right to buy those games online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price, for the better or worse. Personally, I think that as long as the volatility is high, it'll create opportunities. The final phenomenon is the anticipation of a recession. Many people are expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because of the debt structure no longer sustainable, or that their business model is just bad. But somehow that system was able to hold its ground, especially in the North American market. This is partially because the capital around the world chooses to come to American capital market when things get heated back home. This is especially the case when geopolitical tensions increased around the world. In order to make sure that the capital can provide steady returns without being affected too much by central bank policies and inflations, this phenomenon will intensify over time. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain low because the real economy cannot just improve because the asset prices go up. As far as we're concerned, that means that the patience of market participants over the next couple of years will be a great virtue, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and your risk level under check. Your speculative positions should play a relatively modest part of your overall portfolio, so thanks for watching. If you like my content, please like, comment, and subscribe to my channel.